Sam Altman runs the most valuable AI company on Earth. OpenAI is worth $730 billion. His company just closed the largest private funding round in history, $110 billion. ChatGPT has over 500 million weekly users. And his salary? $65,000 a year. That's less than a mid-level accountant in Denver. The financial structure behind Sam Altman's wealth is one of the most audacious bets in modern history. And if it pays off, it doesn't add billions to his net worth. It adds tens of billions, almost overnight. And the way he built it teaches you something most people never figure out about money. Right now, artificial intelligence is the biggest wealth transfer event since the internet boom of the late 1990s. According to PwC's Global AI report, AI is projected to contribute $15.7 trillion to the global economy by 2030. That's not a typo. Trillion. And sitting at the very center of this transfer is Sam Altman, a 39-year-old from St. Louis who dropped out of Stanford, built a location app that sold for $43 million, and then spent a decade quietly placing bets that most people laughed at. Here's what's strange. Sam Altman's net worth as of April 2026 is estimated at around $3.3 billion, according to Forbes. That sounds enormous. And it is. But compared to the company he runs, it's almost absurdly small. Elon Musk owns roughly 13% of Tesla. Mark Zuckerberg owns about 13% of Meta. Sam Altman owns 0% of OpenAI, zero equity. In the company that invented ChatGPT, the company that is preparing for what analysts at investor.gov are calling potentially the largest technology IPO since Google went public in 2004. Here's the thing, most people get completely backward about Sam Altman's salary. The $65,000 isn't a sacrifice. It's a strategy. Sam Altman's salary at OpenAI is $65,000 a year, according to the Wall Street Journal. In San Francisco, where he lives, that salary barely covers rent on a decent apartment. But Altman isn't living on $65,000. He's living on the returns from a portfolio that spans over 400 companies. Now you might be thinking, okay, that makes sense for someone already worth billions, but how does this connect to me? Here's where it gets interesting. The reason Altman structured his compensation this way isn't just tax efficiency, though that's part of it. It's about what economists call opportunity cost signaling. By taking no equity in OpenAI and drawing a minimal salary, Altman positioned himself as a mission-driven operator, which made him uniquely trusted by both his board and his investors. That trust gave him access, and access in venture capital is the actual product. Let me show you the math on this. The average American CEO of a major company takes home roughly $14 million per year in combined salary and stock, according to the Economic Policy Institute. Over 5 years, that's $70 million, before taxes. Altman, instead of taking $70 million in W-2 income, has been compounding investment returns across 400-plus startups. His stake in Reddit alone, over 12 million shares at roughly $131 per share as of early 2026, accounts for approximately $1.59 billion of his net worth. That's one investment. Here's the kicker. Had he taken a traditional CEO salary, every dollar would have been taxed as ordinary income, up to 37% federally. His investment gains? Long-term capital gains rates, typically 20%. Everyone talks about OpenAI. Nobody talks about the machine underneath it. Sam Altman's fortune is anchored in early bets on a portfolio spanning more than 400 companies. Early wins include substantial stakes in Stripe, Airbnb, Instacart, and Pinterest, managed through a vehicle called Hydrazine Capital. These aren't passive index fund positions. These are early-stage investments, meaning Altman got in before the valuations exploded, often at prices 10 times, 50 times, or even 100 times lower than where these companies trade today. Now, you might be thinking, that's great for him, but he had access I'll never have. That's partially true. But the underlying principle, front-loading your exposure to asymmetric opportunities instead of trading time for salary, is available to everyone. The vehicle is just different. Altman also serves as chairman of Helion Energy, where he has personally invested $375 million. The company recently hit plasma temperatures of 150 million degrees Celsius as it pushes toward viable fusion power. They're not diversifying to reduce risk. They're concentrating in categories they believe will be structurally dominant within 10 to 20 years. And they're doing it early enough that even a partial success generates life-changing returns. The person investing $500 a month in a Vanguard S&P 500 index fund is practicing a version of this same logic. Early exposure, long-time horizon, asymmetric upside. The scale is different. The principle is identical. This is where it gets really interesting and genuinely unprecedented. OpenAI is currently valued at $730 billion following a record-breaking $100 billion funding round. And OpenAI is now moving toward a for-profit structure and a potential IPO. The company has surpassed $25 billion in annualized revenue, faster than any enterprise software company in history. A potential IPO could value OpenAI near $1 trillion, placing it among the 20 most valuable public companies on Earth before it turns a single dollar of profit. And Sam Altman currently owns 0% of it. A plan under consideration would grant Altman a 7% equity stake in OpenAI, which at a $730 billion valuation would be worth over $51 billion. At a $1 trillion IPO valuation, that 7% becomes $70 billion. That's not wealth. That's a different category of existence. OpenAI has now completed its restructure to a public benefit corporation, with a separate nonprofit foundation holding a $130 billion stake in the for-profit arm. OpenAI is projected to lose approximately $14 billion in 2026 alone, driven by compute costs, research spending, and infrastructure build-out. It's spending faster than almost any company in history. And the market doesn't care, because the revenue growth curve is equally historic. Look, delayed compensation, if your bet is right, doesn't just pay out. It pays out exponentially. Now you might be thinking, okay, Raj, this is all fascinating, but Sam Altman got into Stripe in 2012. That ship has sailed. What does any of this have to do with me? Everything. Because the underlying financial behavior Altman has practiced for 15 years is replicable at any income level. The core move is this: minimize taxable income, maximize equity exposure, and play long. Take two people, both earning $75,000 a year. Person A spends everything. Reasonable lifestyle, no investing, no assets being built. Person B invests $500 a month into a Vanguard total stock market fund from age 30. At a historical average return of 10% annually, according to data from NYU's Stern School of Business, Person B has $1,139,000 by age 60. That's not a typo either. Most people think wealth requires a higher income. Altman's story proves it requires a longer time horizon and a better structure. He took $65,000 a year and built $3.3 billion. You take $500 a month and build 7 figures. Same principle, different zeros. Altman's entire financial architecture rests on 3 pillars: early-stage equity exposure, tax-efficient compensation structure, and long-time horizon. You can replicate all 3.
What's your current savings rate? Be honest, no judgment. I read every single one. If you want to understand exactly how Zuckerberg turned a $19,000 investment into a $1 billion valuation in just 4 years, watch this video to know the exact breakdown.